this.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Real Investment Show for Monday as we get ready for a whole new week. Of course, we're also approaching the end of May already. It's already a month behind us. Everybody's getting out of school soon, so kids are home for the summer. But a couple of things this week. Not a lot of earnings this week, except for NVIDIA later on this week. And then also, we've got quite a few Fed speakers out today as well. Actually, this week we've got a few Fed speakers. So again, kind of all eyes are going to turn back to the Fed here, with the vast majority of earnings season now behind us. All the big companies are in it, but except for NVIDIA. There's already kind of a view. Earnings came in better than expected. Earnings revisions are on the rise right now, at least right now for the rest of the year. So that's all being supportive of markets here near term. Buyback announcements are running at a pace well above normal this year for the first quarter. So we've got a much stronger ratio of buyback announcements coming out than normal that we do during the time of the cycle. Of course, since buybacks have made up about 100% of the net equity purchases since 2000, that's important for markets, right? That gives that market lift because it's a buyer of equities in the market. So again, if you kind of wonder why markets kind of continue to rally despite other things that are going on, a big reason for that is the enormous amount of share buybacks that are going on. In fact, we had talked about back in February and March that we were likely going to have a correction as we entered that buyback blackout window where companies could not buy back their shares heading into earnings season. As soon as that buyback window reopened, markets started rallying again. And so again, that just goes to show you the importance now that buybacks play within the overall market environment. So a couple of things coming up this week. We've got a couple of articles this week coming out. One out on Friday talking about the risk of recession. There's a large majority of investors right now, about 65% of investors currently think that there is absolutely no risk of recession, at least in the next 12 months. Doesn't mean we're never going to have a recession again, but they think in the next 12 months, absolutely no risk of recession in the next 12 months. Economists are pretty much universally agreed right now that there's no risk of recession. So again, if you kind of look at the outlook, recession is not a risk. But, and as we're going to go into in this Friday's report that's coming out, the risk of recession is not zero. And we kind of go through some of the reasons why, some of the current economic data that's coming in that suggests that the risk of recession may be higher than what a lot of the mainstream economists think. And again, I don't know. Personally, I don't know if we're going to have a recession in 12 months, in 24 months, in 36 months. We can certainly do some assessments. Will we have a recession again? Yes, at some point. If you keep calling for a recession long enough, eventually you'll be right. So I don't know when a recession is going to come, but we can make the case by looking at some of the data that the risk of recession is not zero. So that article will be out on Friday as well. So again, just a few other things kind of, paying attention to. Again, we do have some economic data coming. That's going to be important. Fed speakers are going to be important. That's going to really what the market's going to turn its focus back to now. The focus of the market, at least for the next month or so, until we get back into June. So in June, around June the 14th, that buyback window closes again because we'll be getting ready for earnings starting in July. So between now and then, it's all be focused about economic data, right? And more importantly, what's the Fed going to do? Is the Fed going to cut rates in their June meeting, or is it going to be September? Do they give us hints in June about when they're going to cut rates? Remember, this entire market rally has largely been focused on the fact that the Fed is going to cut rates, right? Easing of monetary conditions that gives support to equity buyers. So, again, that's going to be the big talking point here over the next month. Is going to be the economic data that's coming in, whether it's the employment report that's going to be coming very quickly at the beginning of June, the one for May, whether it's retail sales, whether it's other economic data, the manufacturing index, etc. That's going to be the big focus. Right now, durable goods are in a deflationary state, right? There's a lot of downward pressure because of high borrowing costs, etc. Durable goods are in very much a deflationary state. Services, however, right, your Grubhub, your Uber Eats, etc., all those services that you use, that's where the inflation's sitting. Inflation is sitting in services right now. That's where prices are remaining elevated. That hasn't fed through yet. But importantly, services are very tied to discretionary spending. Because again, that's what we're spending money on right now. We spend more money on services than we do on actually buying durable goods. So if the consumer begins to contract, so you want to be paying attention to retail sales, personal consumption expenditures, because if that begins to weaken markedly, that's where you're going to see the deflationary pressures start to hit services. And that's the one thing that right now, the one big challenge for the Fed is that services-based inflation. So we'll keep a watch on that, but that's the one thing to be looking for over the next few months is really paying attention to what's happening with the consumer more than anything else. All right, let's talk about what you need to know before the bell this morning. It's a brand new week, so we finished the week last week, Friday. We finished on a positive note, and again, markets are doing okay here. Absolutely nothing wrong. We're sitting at new all-time highs. The question will be whether or not we get a bit of a pullback here. Markets are very overbought on a short-term basis, very extended, still on that buy signal. So again, at least in the short term, there's not a lot of risk of big downside in the markets. And of course, that's something to certainly, pay attention to. But right now, a correction back towards that 50-day moving average, which is sitting right where the 20-day moving average. Now, the 20-day moving average will probably cross the 50-day in a bullish cross in the next day or so. So, I mean, we're sitting, that junction is right on top of each other right now. But a pullback back towards that support would be very healthy for the markets in the near term. We're overdue for that. Given the overbought condition of the market here, I would certainly expect that we're at least going to either have some consolidation where the market just doesn't go anywhere for a bit, or we do get a little bit of a pullback here. But again, what we're looking for at this moment is this 20-day moving average to cross back above the 50. That's going to provide an elevated level of support for markets. So pullbacks back to the 20-day. We kind of get back to where we were previously from October of last year through basically March, where the 20-day moving average, that rising 20-day moving average, was acting as consistent support for the rally in the markets. That's what you're looking for here. So this 20-day starts to turn back up, which it has. That's bullish. Crosses above the 50, and then as it clears the 50, it becomes new support of that 50-day moving average. So again, markets start to pull back just to the 20-day moving average, doesn't decline to the 50. That's the potential of what we're looking at here. So again, short-term pullbacks, at least in the near term, need that to reduce this overbought condition. But again, there's nothing here at the moment in terms of the markets to be overly concerned about. The markets are certainly not concerned about some of these bigger headline issues that are going on. I know there's lots of reasons to be concerned, like, oh my gosh, what's going on in Iran or in Israel or in Ukraine or what's happening with inflation, whatever it is. Lots of reasons to be certainly concerned about things, and certainly don't want to dismiss any of those issues. But the markets right now are not worried about that. So our goal here in the near term, we have to make money with markets as markets are rising. Certainly need to pay attention to those bigger event issues that may eventually occur. And the markets will certainly let us know when those become an issue. But as we've always said, remember, the thing that gets the markets is not the thing that we know about. It's the thing that surprises the markets. The markets are factoring in all these other things: inflation, stagflation, geopolitics. Market is already factoring in the things that it knows about. The thing it doesn't know about, the things that you and I aren't even paying attention to right now, That's the thing that potentially breaks the market. We don't know what that is, but right now, the market is doing fine. So again, let's participate. Let's make some money. That's our job. That's what you need to know before the bell. When we come back from the break, we'll get into our newsletter from this weekend, talking a little about deflation, disinflation in the overall economy. Don't go away. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So Brent put an interesting quote on my screen this morning. He says, you know, the biggest problem with pushing all things AI is wrong direction. I want my AI to do my laundry and my dishes so I can do art and writing, not for my AI to do my art and writing so I can do laundry and dishes. It's kind of an interesting story out. There was a article out this morning talking about how artificial intelligence has now learned to lie and deceive. So they've been running tests on AI, and they have figured out that what you feed AI is what comes out, right? So it's kind of, whatever information you put in, it's what the information comes out, which is kind of interesting because OpenAI, who is one of the big drivers of, training artificial intelligence, just signed a contract with Reddit to access all their data to train AI with. Well, if you've ever been to Reddit, it's nothing but lies and garbage and memes and nothing useful. There's no useful information coming out of Reddit, so and much less truthful information coming out of Reddit. And so you're going to train AI with this, and so not surprisingly, AI has learned to lie and deceive in order to win games, right? So they play games with AI, and AI has learned to cheat in order to win. So I'm not sure that's what that tells you about the future of AI, but I had to rewatch Will Smith's iRobot over the weekend just for a primer. So, so a couple of things. Just talk a little bit about this risk of recession, and there's a lot of concern right now. It really depends on which side of the camp that you're on. Is that there's a lot of problems economically. We're going to have this massive recession, and there's not any evidence of that right now. At the same time, markets are rallying to all-time highs on bad news. And bad news, of course, is good for the markets, at least for now. because that means the Fed will cut rates. And this is the irony of everything at the moment, right? That bad news economically is causing markets to rally. That shouldn't be the case, because bad economic news means ultimately that you're going to have slower earnings growth. That's where earnings come from. You can't manufacture earnings indefinitely. Now, we can do it right now, right? We can manufacture earnings through buybacks. That's why you have record levels of buybacks at the moment, because that boosts your earnings per share. So we can manufacture earnings in that regard. But again, if we take a look at where earnings growth is coming from, it's coming from basically about 10 stocks. If you strip out the 10 stocks in the S&P 500, there is no earnings growth and hasn't been really since last year. So the vast majority of earnings growth is coming from Apple, Microsoft, Google, etc., which is pretty amazing. I mean, just if you just kind of wrap your head around that for a minute, that 10 companies are basically driving the entire earnings of the market. But if we start digging down into the earnings data, there's a few things that we learn from that. So one, again, as I was saying earlier, is that if you take a look at durable goods price pressures, those are falling through the floor, right? There is deflation in durable goods. Those things are getting cheaper because people can't afford them. In services, prices are remaining elevated because that's where we spend the bulk of our money. Back in the 70s, when we had high rates of inflation, the economy was 80% manufacturing, 20% services. So manufacturing drives higher prices because of the multiplier effect. If I manufacture something, I require a lot more throughput of that dollar. In other words, a dollar spent on manufacturing something creates about $5 worth of economic activity. So we had very high rates of inflation, economic growth back in the 70s because you had this massive chunk of your economy driven by manufacturing. Services have an almost negative multiplier effect. So today, because you have 80% of the economy in services, this is why you see this kind of dichotomy of this very strong service sector, but economy is really not growing all that strongly. And that's because of the fact that you have a very low multiplier effect coming out of services. So goes the consumer ultimately, will also go consumer those service prices, right? So if you take a look at retail sales, and this has been, kind of the interesting point over the last couple of weeks, is that, back in February and March, we had these really strong retail sales numbers. Now they've all been revised lower. So basically there's not been much of retail sales growth over the course of the last several months. And that includes some major shopping periods of Valentine's Day and Easter and spring break that all occurred. So all that strong retail sales growth that we thought we had really wasn't there. So the consumer is certainly showing signs of starting to slow down. But importantly, if we take a look at retail sales going back, now retail sales as a function only go back to 1992. So once we inflation adjust that, do year-over-year changes, we can get data back to 1994. So we don't have a really long history of retail sales, but we got enough to make a general assessment about the strength of the economy. And right now, when you take a look at retail sales, they're growing at a rate that is normally associated with very slow economic growth. It's trading at the lower end of its range. So again, it's not, we're not pushing out this really, really strong rate of retail sales growth, which tells you that the consumer is beginning to struggle here as, prices are eating into discretionary incomes and, they're having to turn more to debt. In fact, we just talked about, recently that it's requiring more and more debt just to make ends meet. And we've talked about how consumers are tapping into things like buy now, pay later, et cetera, just to fill that gap. But if we take a look at savings rates, that's been declining sharply. We're back to really kind of pre-pandemic levels in terms of savings. Debt is continuing to rise. The amount of debt that people have to take on just to make ends meet, just to support the standard of living, that continues to rise. And that's being supplemented by, continuing increases in debt. And that's fine. We can certainly manufacture some growth for a period of time, but there is a limit to that debt. And this is the one thing that, is very important to pay attention to, is that historically, when we take a look at, debt ratios, those things, one thing we can't do, or one thing we don't do, we look at like debt to income ratios and we say, oh, well, everybody's fine, right? Debt to income ratios are very low. The problem is we don't break it out. And when you take a look at the debt service ratio of the bottom 20% of income earners versus that of the, top 5% or the top, 10%, et cetera, they have, people in the top 20% of income earners, they've got very low debt ratios, right? They got plenty of income. They don't have a lot of debt. Their cars are paid off. Their house is paid off in a lot of cases, whatever. Their debt to income ratios are very low. The bottom 80% has a very different story. They almost solely, entirely depend on debt to make ends meet and to sustain their lifestyle. So it's very important that we take a look at what's happening at that bottom 80% of the economy, because they make up such a large chunk of the consumption of the overall economy. And importantly, their share of income has dropped markedly. And so if you take a look at the income ratios of the bottom 80%, that's that blue line, their share of income versus the top 20% versus the top 5%, very, very different stories, right? The share of their income continues to decline, which means that as their share of the income declines, their ability to make ends meet becomes much more challenging. Again, but they make up the vast majority of the consumption because they spend every dollar that they make just to make ends meet. So they're the ones out there spending. Now, when you take a look at savings ratios and those type of things, that's mostly people in the top 20% of income earners because they have the ability to save money. And, there was an interesting study out last week talking about younger generations. They're now tapped out for the most part. They have reached kind of the limit of their credit cards, their debt. So if you take a look at Gen X and millennials, they have reached that level of just being tapped out on credit. And that makes sense, right? They haven't had time to build earnings power. They don't have savings. They haven't built, long-term credit records where they've got ability to take on a lot of debt. So they're going to hit their limits first before Gen X's and boomers. But also Gen Xers and boomers typically have more money. They've worked longer. They've saved money. They've got more money in savings and investments, whatever. So they've got more runway to get to being tapped out, but even they are beginning to reach that level. So we're seeing more and more of this issue of people kind of being tapped out. And if we take a look at credit card delinquencies for age groups, kind of across brackets, the level of delinquencies, these are seriously delinquent credit card. So this is 90-day plus delinquent. I haven't made a payment on my credit card in more than 90 days. That is rising. So again, the point here is that we are reaching the limits of consumers and their ability to consume. And that's going to get ultimately reflected back into lower prices. Now, this is important because if we take a look at consumption, so retail sales, as we were talking about before, they make up 40% of personal consumption expenditures. Personal consumption expenditures is 70% of GDP. Don't show that yet. We'll come back to it. But when we come back from the break, I'll explain to you why disinflation is the bigger threat right now in the economy than not. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show. So again, just for the break, talking a little bit about debt, deficits, debt, household deficits, of course. And, so far, the ability to take on debt has, kept retail sales going. That's, helped create inflationary pressures. We gave people all kinds of money during the pandemic, so they went out and bought a lot of stuff when we didn't have the ability to produce it. So you had a supply-demand imbalance that led to inflation. And so we've worked through that cycle now. And now we've gotten to the other end of it, to where the ability to take on increasing levels of debt are now starting to run out. And so the consequence of that, the natural consequence of that, is going to be a reduced demand in the economy. And of course, reduced demand, you have supply, demand imbalances, and you have reduced demand, prices have to fall in order to liquidate supply. So prices come down. And so now you go to that chart, Brent. So if you take a look at, as I said earlier, retail sales make up about 40% of personal consumption expenditures. Personal consumption expenditures make up about 70% of economic growth. So if you take all the government spending, all the business investment, that's and import net exports, so it's imports less exports. You take all that, that's 30% of the economy. The other 70% is everything that you and I buy, sell, do, right? Services, durable goods, etc. So as PCE declines, and obviously because it's such a high percentage of GDP, there's a very, 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 very high correlation between PCE and GDP. And there's also high correlation between PCE, GDP, and CPI, right? Because obviously if you have slower economic growth, you have less demand, so CPI falls. And so that's where we are in the cycle, right? We're still elevated because we're still running through all that excess, buying power that we had. We're still getting to the other side of that, but now we're starting to see the impacts of the ability to take on more and more debt. And, we had paid down a lot of credit card debt during the pandemic. After everybody got stimulus payments, they paid off their credit cards. It was great. Now they're running them all back up again. We're now back to record highs in consumer credit. And so that's the continuing issue. Now we're also starting to see this in some of the other areas of the economy as well. It's not just the retail side, but we're also seeing it in the latest NFIB report. And again, small businesses make up 50% of the employment in the economy. They make up a very big chunk of the purchasing power of the economy, et cetera. So small business is always very important. And the firms that were surveyed expecting higher input costs have dropped markedly. There's a very high correlation between input costs and CPI. And the number of firms seeing higher input costs are declining sharply. And again, that has just really started, as of late, just really taken a turn for the worst. And it had been rising for a little bit. We were having those hotter prints of inflation, right? But lately, that's turned very sharply negative. And again, we'll see if this continues. But right now, what we're seeing going on in terms of small businesses expecting higher input costs, that's falling pretty quickly. And of course, retail sales, as I said, very important, right? 40% of PCE. Small businesses expecting an actual retail sales are at very recessionary levels. In fact, we haven't been, this bad in terms of expectations and actual retail sales really since the pandemic, or even going back to the 2008 financial crisis. So what's going on in small businesses is not great. It suggests that the economy is running much slower than even what headlines currently suggest. But more importantly, that leads into CapEx. And we were talking about earlier, so if 70% of the economy is PCE, capital expenditures, that's business investment, is very important. And that CapEx runs a lead time to GDP. So it just hasn't reflected yet, but there's been a very sharp drop in CapEx plans for small businesses. In other words, they're not looking to hire more people, build another store, buy more inventory, et cetera. That's all gotten fairly negative as of late and continues to decline here because, again, they operate on demand. And that's, this is what I was saying earlier. If you just take basic economics, and that's all there is to it, inflation is a function of supply and demand. And so the reason we had higher inflation post 2020 was because we cut off the supply and boosted the demand. And so as that returns to normal, prices will fall. That's just basic economics. That's the way it always works. And that's what's happening with businesses. They are seeing that lack of demand, and so they're now starting to cut back, reducing CapEx expenditures, et cetera, within their businesses. And, this is, again, a very important point. As I said earlier, small businesses are very representative of what's going on in the overall market. And again, as we talked about earlier, you strip out the top 10 companies, you strip out Apple, Google, Meta, those guys, Amazon, there's not been any earnings growth since the fourth quarter. So since the fourth quarter of 2022, the market is up 48%. And so all this time, right? So since the fourth quarter of 2022, market's up 48%, and there's been no earnings growth for the bottom 490 stocks. It's all been in the top 10, really top 7, but basically the top 10 companies are where all the generated earnings growth come. Of course, they're also the biggest buyers of stock, right? So they're buying back more shares of their stock than anybody else. But there's also an important part about that is that stocks are rallying in anticipation of monetary policy, not earnings growth. obviously markets are going up and based on aggregate earnings growth. But again, if you kind of really looked at what's going on with companies, you've got 10 companies driving the entire earnings growth. And that certainly leaves you a little bit suspect about the strength of the real economy. But this also comes up to this other point that we've talked about recently, is that, lots of conversation, lots of talking about all these bad things that are going to happen. And the market's up 50% since quarter four of 2022. And, this is why, as we kind of keep going back, it's important to pay attention to this stuff, right? Because these are the bigger drivers of the markets, of the economy, of those type of things. But right now, the market's looking past all that at the moment and looking at monetary easing. Because of the Fed cuts rates, that should help boost economic growth, lowers borrowing costs, that helps the economy, reduces debt payments because the interest rates come down. So variable rate credit cards, those type of things, their payments come down. That helps the consumer. So that's why the markets are looking, at that monetary easing as a boost to the economy. Again, I don't think it solves the problem. And these issues that we're talking about, they take a long time to mature. So again, this market can continue to rally here in the short term. So over the next 3 months, 6 months, 9 months, a year, this market can continue to rally. Now, at some point, these things are going to matter. And the markets will tell you when they start to matter because they'll stop going up. So, when markets start to break support levels and turn lower, then you'll know that the market is now recognizing these issues. So this is why it's important to pay attention to these issues. But these issues also don't mean go hide in a bunker and wait for them to mature. Because again, I could have made this same argument and much worse back in October of 2022. And, could sit in cash, since October of 2022 and not made any money. So, this is why it's important to separate out long-term macro views from what's happening in the markets. Those two don't always agree with each other. Now, one will eventually be right. Either the market will be right and these things will improve, or the market is wrong and, we're going to get, a bigger economic drag. Earnings are going to decline. Markets are going to correct, those type of things. But again, that will be a cyclical event that will lead to the next, buying opportunity to put capital to work. So again, it's always important to keep these things in balance. The one thing we're not going to have, at least at this moment, is some type of economic devastation, right? That's not going to happen. Got a lot of emails over the weekend from people talking about a variety of videos that were out over the weekend talking about doom and gloom and, kind of end of the world stuff. And it's like, yeah, that may happen someday, right? You and I probably won't be alive for it, but yeah, certainly those things can certainly happen someday. And, what causes it? Who knows? But again, our job, as I said earlier, is we need to make money right now and we need to build wealth. And that was kind of a conversation that I had with Adam over the weekend, is that our job is to make money. And we talk about the bottom 80% of the economy and the struggles that they're having. The reason you're listening to this show is because you're investing capital to not be in that 80%, right? The whole goal for you is not to be in that 80%. So don't worry about what that 80% is doing. Worry about what keeps you out of that 80%. You want to be in the top 20. And that's why you're listening to financial talk shows at 6:43 in the morning Houston time, right? This isn't kind of the thing that the bottom 80% does, right? They're just working to make ends meet. The thing that we're trying to do is saying, okay, look, I understand that. I understand what that issue is, and I don't want to be in that 80%. I don't want to be in that 80%. I want to be in the 20%. I'm investing capital. I'm building my wealth. So that's what we need to focus on, is how to build wealth even in this environment. You may not like it. I don't like it. But we need to build wealth in it. That's our job, right? Our job is to make money. All right, when we come back, get ready to wrap up the show, get you started for the day. Futures are up this morning. Not a lot, but some. Interest rates are down. Stocks are up. At least that's the way it looks like it's going to start the day. So we'll talk about some more when we come back on the break. No way.
Investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, obviously, over the weekend, we had this big storm, and they came in and knocked out power here in Houston. On Friday, I had to come into the studio, and we had power here in our building. Fortunately, we had power in our building. It was one of the areas of Houston that didn't lose power. It was very interesting in Houston because it was very spotty. My son had come home from college, just to give you an example, came home from college on Tuesday for a couple of weeks before he goes back to summer school. And so he's saying, he says, Dad, so this is like on Wednesday, he says, this weekend I really want Kolache Factory, right? So he just really wanted Kolache Factory this weekend. So on Friday, the power goes out. Actually, on Thursday, the power's out. Friday, the power's out at our house, and so we have no power. And it's pretty amazing. I mean, it's right across the street from me. I've got pictures, big. I live in a little neighborhood. It was built back in the early 60s. And so all the houses were, they all got flooded during Hurricane Harvey. They've all, a lot of them have been, kind of remodeled since then. But there's all these really big, massive oak trees that have been there forever. And, it was amazing because right across the street from me, my neighbor had an oak tree fall, and it fell right in front of the house. I mean, like 1 inch further towards the house, it would have been on top of the house. I mean, it clipped. The gutter on the house came off the house when the tree fell. That's how close it was. Just to the right of me, another house, a massive oak tree. Right around the corner, massive oak tree fell through. Those big RVs that probably cost $200,000. Those really nice ones. Yeah, this one is now 2 RVs because the tree fell right through the middle of the RV. But I haven't seen this many trees down in Houston really since Harvey, when we had that hurricane blow in. Anyway, so we're out, no power on Friday. I came down to the studio, recorded our weekly Thoughtful Money interview with Adam Taggart. And on Saturday, no power. So I had to, come down to the office and do a bit of work here on Saturday morning to get the newsletter put out, et cetera. And, so finally, I finished up my work early here, got the newsletter out. And I said, well, I'm going to swing by Kolache Factory on the way home. Well, power was coming on. So they were getting power on around areas where I lived, right? And it was kind of spotty. Not every neighborhood was out of power. Just our neighborhood was out of power. The neighborhood next to us had power. but it was real spotty. And so I went down Memorial. There was a Kolache factory close to our house there on Memorial. There's power up to Kolache factory, power after Kolache factory. Kolache factory has no power. So my son got no Kolaches this weekend. But I went home and I picked him up, and I did figure out how to solve the power problem, because we went to Slotsky's to have lunch and came back home. We had power. So apparently if you go eat at Slotsky's, you get power. So I'm just encouraging you to go have a sandwich today if you have no power, and maybe it'll work for you too.
A Slotsky's a day.
Slotsky's
Keeps the hungries away.
So, but anyway, yes, we finally got power back, and thankfully it's been much better. And I feel sorry for people up north where it may still be a couple of weeks in some places before they get power back. So our hearts certainly go out to them. It's been a mess, to say the least. There's been a total, I think, of 7 deaths so far from the storm. One of them was a guy trying to move a power line. Do not touch power lines, no matter where they are. That's just not a good decision. Anyway, so we have power back. But I'm sorry, I forgot the reason. The reason I was telling you the story is that when I had built my house in Katy previously, we went through that whole storm, that freeze here in Houston that basically shut us off without power for about a week when the power grid went down, et cetera. And so I installed a generator in the house after that occurred. And of course, I sold my house about 2 years ago. Now coming up, actually in July of this year will be 2 years since we sold our house. And the house that we're renting, I do not have a generator. And now I remember why I bought the generator previously. So I may have to buy a new generator when we get moved into our new house. We'll have to buy a generator.
My generator ran for 3 days.
Yep. It's natural gas powered, right?
Yes.
Yeah.
Yes.
That's the only kind to get.
Right.
Yeah. You only get natural gas. But it's a Generac, right?
It is a Generac, 22 kilowatt.
Yep. Yeah. That's what actually I used your guy that you referred to me.
Oh, okay.
That was the guy that I used to put the generator in the old house. So.
I'll hook you up.
Okay. Yeah, you have to hook me up again. Not ready yet, but let me get moved in. But yeah, definitely. But yeah, it's definitely where, and it's one of those things like you'll put a generator in and then you'll never need it.
Yeah.
So it's kind of like an insurance policy, but it seems like we're having more of these events in Houston now than we did before.
Well,
so
I've used it twice since then.
Yeah.
Yeah.
So
it pays off.
Yeah, there's nothing like not having power.
Well, and when you depend on it to do your job, like you do and I do, because I do a lot of stuff from the house.
Yep.
You got to have it.
Yeah. Well, no, and it's great to have power. Of course, you have no internet.
I do. I'm on fiber.
Oh, okay.
Yeah.
Look at you, Mr. Prepper.
Dude.
Dude, you're like over here. You got food for a week up in the closet somewhere?
Yeah.
Okay, there you go.
Lance's crackers.
Exactly. Those will last forever.
Yeah.
Okay, so a couple of things just to wrap up the show this morning. Again, not really much going on this morning. We do have Palo Alto networks out today. Zoom is out. I think that's the interesting one. We're long Palo Alto networks, so I'm curious, of course, what they report. But Zoom, we don't have an interest in. But that was one of those stocks, kind of like Peloton, which just took off during the pandemic because everybody was going to be working remotely. We're all going to be doing Zoom calls, and now and it's interesting now because you have Microsoft Teams, you've got Zoom, you've got StreamYard, you've got all these. Everybody's come up with their own streaming service now of some sort or another, so you can have these online meetings. But we still call them all Zooms, right? That's become, you know that you have pioneered something when you become the moniker for it. It's just like this is, if you go up north, they call it pop, but in the South, we call everything a Coke, right? You want a Coke. Well, what kind of Coke you want? You want Sprite, Mr. Pibb, Dr. Pepper, Fanta, what do you want? I want a Coke. It's not pop, it's Coke. And so that you have made it when you become the moniker. I want coffee, right? Starbucks? No, what kind of Starbucks do you want, right? We've got BlackRock, we've got this, the other thing. So, you become the moniker. Zoom became the moniker for online meetings. And it's interesting now because this is one of the things that we talk about a lot is that when you're investing in a company, you want to make sure they have a really wide moat, right? A barrier to entry. A company that is very hard to get into, right? They have a very protected share of their market share of their environment, because it's very hard to penetrate their particular market. Takes a lot of capital, takes a lot of intellectual property, whatever it is. Think about defense companies, right? Lockheed Martin, Raytheon, et cetera. You can't just go out and start a defense contracting service, right? It just, you've got to build something, you've got to get it tested, and it takes just a tremendous amount of capital and intellect to do that. So there's a very high barrier to entry to those type of companies. Company like Zoom has a very low barrier to entry. I can get a couple of Indian programmers together because they're smart, they're fast, they're cheap, and I can build an online streaming service. And I can do that fairly cheaply. And so that's a very easy barrier. That's a very easy moat to breach to get into that business. And again, it's like, even like we have SimpleVisor, right? So we contracted out with some Indian programmers who work cheap. They work fast. We work on different time zones, but they're very efficient. And we're able to run that website very cheaply and develop new tools, new technology, et cetera. There's not a big barrier to entry, right? There's a lot of people that have that, right? That type of service, robo-advising, online research, tons of people that have that. It's a very low barrier to entry to do that, right? So there's not a lot of defense for companies like Zoom to protect their market share. So if I come out with something just a little bit better, a little bit more efficient, has some features that we're needing, like for instance, we recently switched. We were using Zoom for our for our online events. We're now using StreamYard because they had some features for interacting with users and things that Zoom didn't have, which allowed us to switch. And so it was just a very, very small change that caused us to switch from Zoom to something else. And again, if something else comes along, it's a very low switch cost for us just to stop using StreamYard and to start using ABC, whatever it is. And that's another thing, that when you're looking at a company, how easy is it to maintain their customer base, right? Because that's where the money comes from. Or is it really easy for consumers to switch from one thing to another? This is one of the problems with the streaming services. If I get tired of, Disney Plus, there's 15 other streaming companies I can switch to get content. So it's a very low switch cost, and it doesn't cost me anything, right? I just terminate my cost at Disney Plus and I switch it over to Netflix as an example, and I'm on my way. So there's a very low switch cost. So maintaining customers is also something to look at. So when you look at a company to invest in, always look at how easy is it for a customer to switch, and how big of a barrier, how hard is it to get into that business? Because that's what drives value for that company over time. And so when you're investing in some technology company, that's where a lot of the risk comes from, which is that it may be the hot thing today, right? TikTok is the hot thing right now. But if something else comes along, if TokTik comes along and everybody switches over there, it doesn't take long for TikTok to lose its base, right? And that's, so that's just something to think about. So as you invest, always look at those things: switching cost and barrier to entry. And it'll help you make better long-term investments for your money. All right, wraps up the show for the day. Have a great one. Be back here tomorrow. We'll cover our article that's out tomorrow on benchmarking and why you shouldn't do it. That's tomorrow's topic on The Real Investment Show. We'll see you then.